Hey everyone, me Kevin here. Can markets continue to head towards all-time highs? Or is it possible that things might get a little poopy? Max, I had no idea it did that. Max put this on my desk and I had no idea it had a sound effect in it. That's actually kind of cool. Anyway, that was surprising. Well, let's understand a little bit of market cycles and try to help understand where we might sit. So this morning in the course member live stream, we did like an hour and 20-minute deep dive on Sofi this morning, and Sofi is a bank. I was talking a little bit about, well, actually quite a lot about the different fundamentals of Sofi and the margins and where they make their money and don't. But one of the things that inspired this video right now is just sort of talk about a market cycle. And so this is my sort of take for a market cycle, is that usually the rapid decline in a market cycle is about a 3 to 6 month process. And really all stocks sort of get hurt in that environment. But what I was talking about with Sofi is how there's probably going to be a delay in the max pain for Sofi because of the type of loans that they have, personal loans, student loans, and student loans which can actually get discharged through bankruptcy because they're private student loans. These sort of washouts or cleanups in a recessionary environment, these can be 2 to 3 year processes. So it takes a lot longer to really feel max pain. I was making the reference to how a lot of max pain didn't hit for certain companies and corporations until 2010, 11, and 12. Even though technically the recession of 08 occurred between March of 08 and March of 09. So a recessionary period doesn't necessarily mean max pain for a particular corporation. And so we're starting to have those sort of discussions in our course member live streams where we're looking at like, hey, when do we think certain companies will hit max pain? And then of course we're looking at, balance sheet and cash flow and price to earnings. We're going through margins and where growth is and all this. I mean, again, I'm summarizing a very small portion of an over hour-long live stream this morning with course members answering questions and this. But I think this is very interesting because we can sort of apply something like this to a broader markets as well. So let's just go here to a little blank page and let's just draw for a moment. Let's draw a similar cycle. So if we just call this the broader market cycle, generally what we try to identify is when are claims for unemployment the highest. And so let's say this is, as we said over here in the Sofi example, let's call this max, this is where stocks really get hurt, right? In this sort of 3 to 6 month falling period. So this right here is the fall from euphoria to stocks getting hurt. This generally happens rapidly. I see this as a 3 to 6 month process because it can happen very, very quickly, this sort of decline, this rapid portion. This portion up here can actually take a little longer, this portion. So euphoria, I guess you could say, might even be a little bit higher, if we maybe move euphoria over here. Sometimes this portion of getting off of euphoria, this could be, 2 to 3 years as well, potentially. And this is why I want to mention, like, hey, can this euphoria keep going? Well, yeah, potentially. I'm not, okay, I don't know what's going on with this right now. Oh, there we go. I'm not saying like, hey, recession's going to happen tomorrow, sell everything. This is actually very interesting because you could stay in a euphoric period for a while. 1998, 1999, 2000, right? It can take a lot longer, and you could even bob around for a while longer. And every cycle is not going to be exactly the same. But I'm more referring to where we sit today, which you could say that we've kind of had some of the Nike swoosh recovery, if you will, since probably November of 22, which does put us about 2 years into that sort of cycle of euphoria, if you will. In fact, my thesis regularly has been that we'll have this sort of Nike swoosh recovery as people see that inflation isn't much of a problem anymore. And what's really happening now is you're getting this sort of hockey stick of euphoria at the end of it, which is interesting. But it also comes with some risks, right? This comes with risk. So if you have a more rapid sort of decline at some point where stocks really get hurt, what are some leading potential indicators of this? Well, something that generally is not a leading indicator would be initial claims for employment. Usually high initial claims for unemployment insurance, they usually happen later in the cycle. So think like midway through a recession. So think more like 2009, as opposed to say, if this is 2007 over here, right? So call it 05 to 07. And then this is like your, Q3, Q4, 08, your 3 to 6 months of pain over here. Then, stocks really get hurt. Some companies are going to have max pain in that sort of like 2011, 2010 period. So anyway, the highest initial claims for unemployment, and we'll look in just a moment, tend to come after that max pain in the stock market. And this is why initial claims for unemployment are a lagging indicator. Now, a lot of people are going to hear that and say, yes, we know that already. But, every time I mention this, there are people that say, Kevin, initial claims for unemployment, they're a leading indicator. Well, it depends for what. Initial claims, which came out this morning, they come out every Thursday, they're a leading indicator for what? The next jobs report. That's really it. Because you add up the 4 weeks of initial claims and you try to sort of predict what the next unemployment, jobs report is going to be. However, they are a massively lagging indicator for recession. In fact, you could see that here. If you just look at initial claims and then you zoom in for a moment, look at where claims spike. See this right here? The claims really took off. They started taking off. Let's make this, this is weekly. Let's show it monthly because it'll just smooth it out a little bit. There we go. They took off here late in 08. So actually about August, Q3. But where did they peak? Peak claims right here, March of 2009. This is basically when the recession was over. This was the last quarter of the recession right here is when you peaked. But they didn't really tell you much about the recession coming until it was kind of already too late. You were already seeing that stock pain when they were actually meaningfully climbing above numbers that you had seen before, right? So you'd have to go above levels that you had seen before, because otherwise you kind of just cast them aside. You have to get above these levels. And what level is that? Yeah, August of 08. You already had massive pain in markets at this point. So this is a sign of a lagging indicator. And you could see this in really any recession over here. Yeah, in 2001, you already had pain, substantial pain in the stock market. You peaked out October of 01. The recession was basically over when you peaked out on claims. Again, hence a lagging indicator. But what's interesting is continuing claims tend to rise into a recession and fall out of a recession. This makes sense. Continuing claims are basically a sign that it's harder to get a job. You could also see this in the 27 weeks unemployed. These are people who have been on continuing claims for so long that they are now not even counted by the continuing claims number anymore. But if the continuing claims number is rising, it means the number of people who are less than 27 weeks unemployed keeps rising. So you actually see this rise going into the 90, and then of course the recessionary environment there. If you then go into the dot-com bubble, look at how it rises in early 2000 and really just climbs until the recession is over when it peaks out. Really doesn't come down until the recession is over. In recovery periods, it comes down. This is when you have true euphoria, 2004, 5, 6, everything's great. And then look, it slowly starts rising again until you get to that sort of climax at the end of the recession. This rising action here happens before every recession. This is a leading indicator. And what do we have over here? Rising action. It's slow though. Look how drawn out that is, that rising action. It's not very rapid, although it's starting to pick up more and more over here. Over here, this shows you coming out of the 2020 era, out of 21 and 22. These were the eras here where it's like, yeah, this is where you want to buy stocks, right? Because it's declining. You buy stocks and hodl. This, when you're moving up, is more of a sign that you're moving into more of this sort of recessionary uptick, kind of like over here, almost like we're at the beginning of an 08, or maybe even over here. So these are somewhat things to watch for. So can things keep going? Of course. One of the reasons things can keep going is because, even if we say, how long of rising claims have we had? We've had about 2 years now of rising claims. So let's go back and just compare how much longer can the boom sort of go on. Well, how long have you had rising claims over here? Call it from right about here. Yeah, 2 years would put you at May of 09. I mean, you already went through that recession in that period, right? So how about over here? Rising claims from about here, 2000. 2 years later, you already had the recession. So you're almost kind of like overdue almost based on this sort of metric, right? Let's look at rising claims from here. Oh, here's a little slower. Okay, let's call that the bottom. November 88, let's go to November 90. Yeah, you were just in it, right? Just in it for the 91. And then, of course, you can kind of keep going back and looking all of these rising claims over here, 81 to 83. Yeah, you're already through the recession. So there is an argument for, where does new money get allocated now? And what I generally like to say is new money allocation at highs with claims and 27 weeks unemployed and all of this. New money allocation to me, it just seems more logical right now with where valuations sit. Logic probably says new allocation of capital ought to consider cash. Obviously we've been, the bond market, which is sort of like a dam. I was talking about this in the Alpha report this morning. It's sort of like a dam that blocks pressure. I guess that would be more like that. A dam that blocks pressure. And the Fed cut rates 100 BP. And what ended up happening? Rates in the market went up 100 BP. So we have now basically tightened by 200 basis points versus what the Fed wants. That's crazy, right? Because the Fed wanted to loosen by 100, but we got 100 of tightening, which means you have 200 basis points more of tightening than where the Fed really wants things to be, which isn't great. And I think this is sort of just a dam that's going to break. And I think some of this, like people are arguing, oh, it's because inflation is popping back up. I don't think so, because if you look at gold should be sensitive to true inflation fears going up. It's been flat for 3 months. This is a sign that the market doubts inflation as an issue, and it's more likely that inflation is being resolved more than enough by these high rates over here. The question is, what damage does this do? And so for me, my thesis, this is just my personal take, it could be totally wrong, is wait for January to March. Because what does January to March show you? Q1 layoffs, maybe even call it April, right? Because then you're going to get the March data. You get the March data in April. So Q1 layoffs, how bad? The other thing, any kind of profit taking, honestly, I don't think people are going to try to take profits in 2024, because why would you? If Donald Trump isn't expected to raise taxes, so why would you take profits this year? He's certainly not going to raise taxes. That's the assumption. Can't guarantee it, but I think we can all agree that's probably the case. But even if he reduces taxes 1%, you'd be better off taking the profits after January 1. Now, profit taking in 2025, much more likely. But something that I do think is a little bit of a risk factor is actually what you're seeing with MicroStrategy and Bitcoin. Because we know that MicroStrategy is open to issuing more stock to buy more Bitcoin. But the problem is MicroStrategy stock has kept getting rejected by 400. And as it keeps getting rejected by 400, there's going to be less appetite for convertible bonds in the $600 to $800 range, which is where they're issuing them right now, which is wild. And so that means the market in Bitcoin's pricing, which is now, sticking around 96K, under 100K, I think the market is somewhat starting to say, hey, there's a limit to how much we're going to be able to issue shares at MicroStrategy since we're getting rejected at 400. And so that means the future buying pressure, that order book of buying pressure at Bitcoin is potentially going to be lower. And that creates some potential issues for getting us back over 100K. So there are some factors here that for me, obviously I don't have a crystal ball, but for me, building cash and maybe diversifying is desirable right now, especially into private. You know, I really like that idea of diversifying into private right now. You know, but yeah, well, I mean, we've talked about this plenty before. So these are just some theses that I have, but I thought talking about the unemployment numbers, it was quite useful because this morning we did get unemployment data. You know, if we look at this morning's Alpha report, we got unemployment claims data this morning, and continuing claims came in at a 3-year high, 1910 versus 1881 expected. And weekly claims were roughly a little bit lower than expected, 4K lower than expected. Let's see what the revisions were. So, I mean, nothing was like a major red flag, but the 3-year high on continuing claims is something to pay attention to. Yeah, revisions were roughly in line. So, something to watch. A little bit of where my head is, though, especially in the face of valuations where they are. Earnings could explode next year, so it's possible that things just keep going, right? So this is the alternate argument, is that, okay, well, can things keep going? Of course. How do things keep going? Well, things can keep going if earnings just explode next year and normalize some of the high valuations. So really, in order for things to just balloon next year, let's briefly touch on that, balloon in 2025, well, you would need, because over here, you're also going to have Trump uncertainty around geopolitics. You know, Russia, for example, just declined a rapid ceasefire for Trump in Ukraine. That doesn't mean it can't get resolved within 24 hours, as Trump has said. But what if it doesn't, right? So geopolitics, tariff uncertainty, but also policy uncertainty. You know, yes, they have control of all three chambers, but does that actually mean you're going to get things through as rapidly as you hope? Not necessarily. So balloon in 2025, it's really going to take earnings and low layoffs in Q1 and low profit taking in Q1. So to me, I just like for new capital for me, my take, not personal advice for you, right? My take, new capital right now, cash. You know, unless of course you're like funding a retirement account or whatever, which theoretically you could fund a retirement account and just leave it in cash. So, some you will have to automatically allocate to like certain funds, but which I guess you could choose a cash fund, but whatever. So new capital right now, cash is my take. Does it make sense to trim on holdings that you have? Depends what your earnings are. You know, if you're making enough money, why sell? Why pay the extra in taxes at this point? You could always sell some calls if you were worried, but then of course if things fall rapidly, then the calls only protect you a certain percentage, and then the rest you're kind of holding the bag on. But yeah, I mean, things could absolutely keep going. It would be very unusual, especially with this sort of like dam, this pressure building against this dam of these higher yields, and what we're seeing with continuing claims. But hey, could keep going. You know, I mean, I know recessions are very, very painful, so I hope you just don't see one, but my take. Anyway, sorry I've been gone for the last few days. Became a licensed pilot. Yeehaw! I made a whole video on it if you want to see it. It's a pretty niche topic and it's pretty in-depth, but if you want to see it, it's on the channel. Anyway, thanks for watching, folks. See you in the next one. Appreciate y'all. Goodbye and good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.